From the SKAITUBE EDU-Series, Dividends 101, presented by Gekko the GEICO. Today, we're going to be looking at dividends, one of the best ways to create passive income for your portfolio. Alright, dividends, what are they? Dividends are the distribution of a company's profits to its shareholders. Now, each company has this option to distribute dividends, and it's really on the basis of that company's profitability and cash. So remember, dividend payouts can vary and change just like stock prices. And as there are 4 quarters in a year, dividends are paid out per quarter. Now, you may be wondering why I put that Andrew Yang gif there. Well, I like his idea of using freedom dividends, but I'm not sure what he's talking about because, the USA, we actually have a deficit problem, meaning we're in a lot of debt and we don't have any profits yet. So I don't know how we would get dividends to every American, but I like how you're thinking there. Okay, why do companies pay dividends? Well, when a company pays dividends, it's more like returning the money, returning a company's profits back to shareholders. It's kind of like a reward and a thank you sign to shareholders for investing in their company. Now, dividends also show that the company is doing well financially, and that gives confidence to shareholders, existing and possible new ones. Now, this confidence can translate into more demand, and that demand can translate into an increase in stock price. So, quick question, why do companies not pay dividends? Well, I think there's really 2 main reasons. Number 1, a company's just not profitable enough, or the profit they're making can't compensate all the shareholders. Number 2, a company wants to take the profits that they have and the leftover cash and reinvest it back into the company. So that's what I think are the main 2 reasons why companies might not want to pay dividends. Alright, now let's take a look at the dividend yield. It may sound a little intimidating and complicated, but I can assure you it's actually really, really simple. So number 1 rule, the dividend yield always comes as a percentage. Don't forget that. It's always going to be percentage. And it explains the relationship between a stock price and its dividend price. And as you can see here, this is an example formula from Business Insider. Dividend yield equals annual dividends per share, which is basically the annual dividend payout, over the current share price times 100. All right? And just a little side note, the board of directors of a company determines the dividend payout. Don't forget that. Alright guys, so now we're going to take a good close-up look from our very own SKAITUBE terminal. Let's look at this company called Johnson & Johnson. So here I have typed in the command !financials J&J, and we get a ton of information, but we're going to block that out for now, and we're really going to focus on its dividend information. So as you can see here, we have the trailing 12-month dividend rate and the dividend yield. So now we have a zoomed up screenshot of the financial information concerning dividends of the company Johnson & Johnson. To get this, you can easily find it by typing an !financials, and the ticker sign is J&J. So here we have the 12-month annual dividend rate, $4, and the dividend yield, 2.51%. And if you guys are still confused about how to calculate the dividend yield, we have a little formula on the side. So we have the annual dividend, $4, divided by the current Johnson & Johnson stock price, $159, and that gives us the 2.51% dividend yield. Now question, what type of investor is focused on investing for dividends? Well, personally, I think one of the biggest investors in dividends are retirees. When you're retired, you don't have a full-time job, and you're not really looking for one, so you need some sort of passive income. And dividends are one of the best ways to get passive income. Alright, quiz time. Let's review some of the content we just went over. What are dividends and what is the dividend yield? Take a minute. Alright, if you guys need a little bit more time, be sure to pause the video. But here are the answers. What are dividends? The distribution of a company's profits to its shareholders, and the dividend yield, a percentage that shows the relationship between dividend and stock price. Congratulations! Moving on, how dividends increase returns. Well, let me give you an example. Let's take Johnson & Johnson again. So let's say that their stock price is trading at $161. I'm not sure what it's trading at right now, but this is just an example. So let's say it's trading at $161 and it jumps to $169. So technically, my portfolio would have jumped 5% from Johnson & Johnson stock alone. But I can't forget that Johnson & Johnson also has a high-paying annual dividend yield. So that's a 2.5% addition increase to my portfolio. So I'm really getting a total annual return of 7.5%. So my total return is really based off of the dividend and the stock appreciation. Now, dividend is my cash realized, meaning it's money that I have actually put in my pocket. Stock appreciation is the paper gain unrealized, meaning that I haven't sold the stock, so I haven't realized the gain yet. Okay, so why are dividends important? Well, dividends, like I said before, are a form of passive income. They're also cash payments, so they can be redirected for personal use. Now, dividends are extremely versatile, so they can be cash payments, or they can also be reinvested in the same stock that you have or in other stocks. And actually, some brokerage platforms or programs allow automatic reinvestment of dividends, so it's an extremely simple process. Now, I want to show a chart here because it just goes to show that dividends can help grow the portfolio substantially over time. And we can see here from 1930 to 2017, the S&P 500 had an annual return of around 10%, maybe a little bit over. And 42% of the S&P 500's annual return was from dividends. Moving on, let's take a look at our final chart here. We're still using S&P 500 as our example, and now we're going to see how dividends can really affect your portfolio. And we're going to use some later times like 2019, not 2017. So let's take $100. We take $100 and invest it in the S&P 500 in 1980. We let it grow until 2019, and we'll have almost $2,000. So 100 to 2,000, that's a pretty big growth gap. Now, we can't exclude the power of dividends, though. So let's say we took $100 and invested in the S&P 500 in 1980, and from the dividends of the S&P 500, we reinvested. We would transform $100 into over $5,000. Now that is pretty substantial growth. Alright guys, I know you're missing me already, but this is the end of the video, and thank you guys for watching. I hope everyone learned a few things about the basics of dividends. If you guys have any questions or feedback or concerns, feel free to send me a text. I'm Gekko the GEICO, and like they always say, just 15 minutes with SKAITUBE can save you 15% or more on your losses. Until next time, guys.